So we had another interest rate cut by the Bank of Canada last week. And the question I'm getting a lot is if the bank keeps cutting, will that lead to higher home prices? I've been seeing a lot of realtors in the industry talk about how lower rates drives home prices higher, almost like it is a scientific fact. So we're going to unpack some of their assumptions, what they're getting at, what I think they're getting wrong, and what we need to be keeping an eye on in the months ahead. My name's John Pasalis. My team and I help buyers and sellers throughout the Toronto area make smarter and more informed real estate decisions. If you want to meet with me and my team, you can just click the link in the show notes below or shoot me an email at askjohn@movesmartly.com. So it's not surprising. I mean, I see a lot of people in my industry, realtors, talking about how lower rates is going to stimulate the market. Don't worry if the market's slow now. It's going to be on fire by the end of this year because lower rates drives home prices higher. That, of course, I mean, is a bit of an interesting statement. Like what all of these realtors are doing, basically, that's like a cognitive bias called recency bias, which basically means that they're overemphasizing events that have happened recently rather than looking at historical trends and historic events. And what I mean by that is there's two events recently that most people in the real estate industry are leaning on. The two big events where rates were slashed and it fueled house price appreciation. The first, of course, was the global financial crisis. The banks slashed rates. The US Fed pushed quantitative easing that drove rates, even in Canada, a lot lower. And of course, this is an economic crisis that didn't really impact Canada very much. There's a bit of fear in the market, but at the end of the day, our economy wasn't really impacted that. So lower rates just pushed home prices higher in that environment. And the other event, of course, was the COVID-19 pandemic, where Bank of Canada slashed rates, went into an aggressive quantitative easing program, which pushed down long-term rates in anticipation of this major economic event that didn't quite materialize the way they had anticipated. Certainly, some people lost jobs. Many of them were in lower paid jobs, not so much in people who owned homes or who were looking at buying homes, which is why after the first maybe 6 or 7 months of the shock of the COVID-19 pandemic, markets rallied, the housing market surged, it went on fire, prices skyrocketed. Again, part of this was that it didn't really impact the average home buyer. There's tons of fiscal stimulus as well, meaning the government was like putting money into people's pockets, supporting jobs. So it wasn't quite the economic downturn that policymakers expected. So it was a slowdown, obviously, that impacted a few. But for the most part, most people who are in the market to buy a home or own a home, their savings increased. They spent more money and they loaded up on real estate. This is largely what's happened. So what's happening today is that realtors are making the mistake by assuming every time rates drop, it means the housing market rallies. It means everyone rushes out to buy an investment property. And this, of course, is a mistake. This is not what happens every time interest rates fall, because we have to think about under what conditions are they falling. And today, it's a very different environment from the global financial crisis. It's a very different environment from the COVID-19 pandemic. I tweeted out a chart the other day showing that detached home sales in the Toronto area, in the GTA, were at the lowest level on record going back to 1997 in February. So if you look at the number of detached home sales in February, there hasn't been a February in history where it is lower than what it was in 2025. And detached home sales are so slow because if you think about who's buying a detached home, most of those people are upsizers. And many of them are worried about losing their job. They don't want to take on more risk. They don't want to take on more debt. They're worried about their current, house not selling. So there's tons of economic uncertainty. Many of Canadians, I think I saw that recently, 50% of Ontario residents are worried about potentially losing their job in response to this changing trade dynamic between Canada and the US. And the thing is, this is what we need to keep in mind. Even if rates go down another 50 basis points, 75 basis points, it doesn't matter because those fears are the barrier, and lower interest rates doesn't kill those fears. People who are worried about losing their job don't suddenly don't care anymore because interest rates are a little bit lower. They're still worried. And this is the challenge we're going to be facing over the next 6+ months is that, yeah, if rates go lower aggressively, they're going down aggressively because we're having a very negative economic event in Canada, potentially job losses. And the job losses, if this happens in response to this trade war, are more likely to be in slightly higher paying manufacturing type jobs. And I think this is a very different environment from the environment we saw, of course, during the global financial crisis and during COVID-19, when many of those jobs were not impacted. So we need to keep in mind that the economic conditions today are quite different. And when we think about under what scenario will we see the market, the housing market rebound, it's not just low rates. I mean, certainly low rates is, of course, one factor. It impacts housing, but we need a sustained period where things are not volatile, things are not certain, where people are not worried about what the US administration is going to do next and how it might impact their job. So people needs to see some stability. They need to see some green shoots kind of economically coming to the ground where things feel stable and fine before people feel more confident to jump in. And that doesn't mean we might not see it. We're not going to see a slight uptick in demand if rates drop. Certainly, there are some people who are confident with their jobs. They're not worried about their losing jobs. They just need a home. They need to upside. They have tons of equity. They're not as worried. So certainly there's going to be some demand and it might tick up a little bit. The point that I'm trying to make is we're not going to see a booming market. We're not going to see, probably not going to see prices skyrocket or surge anytime soon for all of these reasons. We need to see a longer period of stability and certainty in the market and the economy for people to become more confident, because confidence is a big factor in what's driving house prices. If you're not confident, you're worried about losing your job, you're not jumping in to invest, you're not jumping in to buy, you're not jumping into upsize. And I think these are going to be the key issues that are going to impact the housing market over the next little while. So, and I don't think those are going to materialize over the next 6 to 9 months. Like I said, even if things stabilize economically between Canada and the US, we need a certain period of stability. We need to see that things have calmed down. There are no more shock announcements from the US. And we need to see the economy actually be stable and not hear about job losses. So I think this is a key thing that is different. I think that's probably one of the things that most realtors who are talking about the market rebounding because of lower rates, I think are missing. And the last thing I'll say is something we talked about a lot of these issues we talked about on our live update. I do a live update once a month with David LaRocque and a couple of agents from my team, where we take questions and Q&As about the latest trends we're seeing. And one thing David, who's a mortgage broker who writes for our blog, and we smartly kind of touched on, is that the other concern that the Bank of Canada has is, well, we know they're going to lower rates if we have a ton of economic pressure. However, one of the things we're worried about is if this trade war leads to high inflation, well, that is going to put some pressure on them because maybe they're not going to lower rates if inflation is picking up. And we could be in this environment where we have weak growth, high inflation, which is a very problematic position to be in for a central bank. So it's not even a slam dunk that we're going to see aggressive interest rate cuts, because if inflation does pick up as a result of these trade disputes and trade wars, the Bank of Canada might be handcuffed because their primary concern is not the economy, it's price stability, which means keeping inflation under control. So we have to be mindful of these changing dynamics. But at the end of the day, I think if anyone's a buyer or seller trying to make sense of this, I don't think this housing market is changing anytime soon. I think it's going to be sluggish. I think it's going to be kind of slow. I do not think prices are going to skyrocket anytime soon, for all of the reasons I described. We need more certainty, more clarity in the market. These concerns about people losing their jobs needs to go away before people start jumping back into the housing market in any significant numbers. I hope you found that helpful. If you have any questions, comments, please post them in the discussion below or shoot me an email at askjohn@movesmartly.com.